Everybody, happy Sunday. You have survived. You've survived World War Z, you've survived OPEX, and you survived, many of you, your very first correction. Tried everything I could to make sure to give you some confidence that we were not in the going to hell bear market that everybody on social media was already calling for you. Showed you what happened with the wars, Vietnam, World War II, even 9/11. Europe made it right back to the levels where it started when the war and the invasion began on February 24th. And I'm going to show you where we all wound up over the course of the end of last week. And I hope that those of you that doubt begin to realize this is nothing but a video game. That's all this is a video game. Fridays, you use quarters. During the week, you can use bigger money and actually buy the games, buy the cartridges. But this is a video game. That's all that it is. If you didn't go through last week's video, I ask you please go through it. I had some uploading issues because of the microphone. I went back, did it again, went over it really quick. Bottom line was, I was telling everybody, look, we're looking for the upside. What hit me and really hit me hard was that we actually OPEXed. We actually went up there and broke that OPEX level. I don't have this up here, but I'm going to go ahead and pull it up, and because it actually amazed me. But then again, it's coming back to what I originally said. This is a video game. It's a video game. It's a video game, and wow. I mean, we came there 44.16 on March 3rd, and then we dropped. And we went up there and we broke in on Friday. All right. But I'm going to show you where we broke in on Friday. Because again, this is what I've been tracking since the January bottom, all your pops. You had a 7% pop over here. You had a 7.3% pop over here. We just popped 7.3%. I'm going to show you how that looks over there. But on OPEX, why I'm saying it blew my mind was here, March. I've been tracking this for a little more than 5 years. I don't think anything prior to Trump matters. So March 1st was your high, and it failed. August 8th was the high, failed. March 10th was the latest one ever in 2020, but that was already a fail because we were going back on February on there. Let me go back. October failed, 2018. November failed. December failed. That was when we had our 20% correction. That was when we had our big wave 4 from over there on that cycle. 2019, May 1st was the high. August 1 was the high. Then you come over here to 2020, forget about COVID, go down into when we started on the bounce. June 8th, the high. September 2, the high. November, when Biden won. It was a fake fail because we went up there, we matched it. Then again, we went up there and we went higher. And the end of the month, right up there to match it. Come over here again into 2021. Boom, February, we hit it, dumped. Boom, we failed over here January. Then we went higher in January 26th. May 7th. September 2, again with the fake fail over in November. But here, January 2, February 2, and then we had March 3. March 3 was our high. Everything from the pattern of the OPEX pattern said that was it, you were going to fail. And that was why over here on Thursday, when we got up to, what'd you do, Cat? Cat's pushing on the keyboards. When we got up here on Thursday to 44.12.67, and then we had quad witching OPEX coming on Friday, I had zero expectations. I was 100% biased that we would wind up failing. We were not going to go through with it, and we were going to start taking that too high, too fast, turn to the downside 4 consecutive days going into the weekend here where we closed higher than the prior close. But let me show you what happened here. And I can't go back into this stuff because, frankly, I wasn't old enough. Over the weekend, you get a tweet here from Bespoke. April Fool's Day, 1980. I was 7 years old. You had The NASDAQ with 4 straight days of 1% gains off of the 52-week low. Had to happen since I was 7. On Friday was the 3rd time since World War II the S&P 500 had 4 straight 1% gains while inside of a correction. May 1970, my parents were drinking and dating. October 1974, I'm 2 years old. I didn't see it. But what I did see was everything that was in the charts. And I'm going to show you this, and I hope you see the same thing that I see. But before I go there, I'm going to keep the browser up here. FinViz. I don't have an account with FinViz, but I do love the data that you can get off of FinViz only because I'm old school, and when I see something I like, I stick with it. And this is something that I've stuck with, and I like it just to give me an idea of where we are. Looking here on their screener, stocks over $40, optionable that are RSI 14, overbought 70, and I only got 3. Only got 3 pages. So in total, there's 44 stocks. That tells me there is an enormous amount of stocks that are out there that have a long way to go before they start getting up on this scanner here that shows on the screen that they're overbought well over above RSI 70 on their daily. Again, I'm going to show you some other stuff when we get to that, but here we are. Here's the SPX, what I've been showing for everybody, right? This is your correction. This is your move down. Here's your correction. Here's your move down. Here's your January bottom, 12.37%. Then we had our 7% rally. Then you had your fade off into the war down to the February 24th bottom, which was the day of the invasion, an 8.35% dip, a little bit lower than where you already were, but most importantly was that 41.9870 line, which I continued to point out, that was your main support level. Over the course of this month here in March, we came down to that once. We came down to it twice. You got your classic spicy trader W pattern. And over the course of this week, we just had a 7.3% rally right to the promised land. In other words, in 50 days of this correction, we went halfway back in 5. This is what I was trying to make sure and get across, that this was nothing but a correction, not a bear market, not an end of the world, nothing like that whatsoever. Red line is your 50-day moving average. As you can see, we came right back to it. One day after, we had the death cross on the SPX, the 200-day cross below the 50-day on Thursday. Here you are again. 50-day, 200 death cross, and then we get this rally that we got on Friday with a short squeeze with $3.5 trillion of options that are out there on quad witching. Biased, didn't see it, didn't buy it, bought next week anyway. Show you here, NDX. Same thing, boom, boom, boom. Little bit of a weak fifth, but again, I pointed out early in the week, table pounding. You hit your 23.6 retracement going back to the 2002 lows. The algorithms are not stupid. They see something like that. They couldn't give 2 shits what sentiment is, what whoever it is tweeting out there, or what Kramer's saying. They are going to throw everything that they can at this because they consider that to be a major bottom. And what did you get? You got your rally right back up here, right to the 50-day moving average. Dow Jones, strongest one out there. Dow Jones barely broke below 10% during this correction. Barely broke below that. You had your little wedge here that was going into the beginning of this week that we just got out of. Bam. Broke out above the 50-day moving average on Friday. Here you are within 6% of the all-time highs. The Russell is your problem. The Russell is your weak point, but the Russell is also your strong point. Since January, you've been consolidating, just sitting there consolidating. And I can tell you, when it comes to the Russell and it comes to spring, this is where the juice, the nitrous oxide is all going to come. It's all going to come over here. It comes out of here every spring going into summer. It's the season for the Russell 2000. This is one that we're going to have to continue to watch to buy dips on, because the IWM is where you're going to see an enormous amount better return for your risk than you are over on the SPY, than you are over on the QQQ. But I want to show you here quick. Not going to take up too much of your weekend. You got March Madness basketball. You got Ukraine stuff to watch on TV. Here is your NQ. This is your 6 hour. Finished up here at 91 on the RSI. As you can see here, 90s are a rare event, normally coming out to you with a peak. You've obviously broken out of this bullish wedge that was forming right up there to that 23.6 going back to the September lows. The NASDAQ is still your weak point. You're still 15%, a little bit right off of the all-time highs compared to everybody else. This is your NASDAQ. It's overbought. Here's your ES. ES, again, same thing. Had that bullish wedge going. Boom, had your breakout. Boom, got right to your 50% retracement of the entire correction within 5 days. Here you are, 92.50 on your 6 hour. 6 hour is not a 1 minute chart. 6 hours is not a 5 minute chart. It's a 6 hour. 6 hours for one candle. It's giving you a wide view of everything going on, and we are undoubtedly, pound the table, overbought. Come over here, get on the YM, and you'll see the exact same thing. 50% retracement of the entire correction taking place there on Friday, within 6% of the all-time highs, and again, up there in the 90s on your 6 hour, extremely overbought. And we will look finally at the Russell, just to give you a look. Bam, bam, bam. And now here you can see what I'm talking about with the consolidation. Just been consolidating down here extremely during the course of this last 6-7 weeks, and fractionally overbought on your 6 hour because you've got less wiggle over here than you do on everything else. Quickly look at the VIX. The VIX falling out of that wedge, coming down here with a buy divergence on the 6 hour. Look a little bit closer on the 5 day. And what we got here is your break down below, right down there at the end of the day on Friday, breaking down below this trend line that I'll show you over here of where the trend line comes from, and that's where it comes from right there. Boom, 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 and you come over here, and what do you see? You've got an oversold daily on the VIX inside of this bearish wedge pattern that you formed right down there onto support. So again, same thing. The VIX also wants to tell you that we have a little bit of a dip that has taken place and that is going to be coming here. Prior weeks after the week of OPEX, or sorry, prior months after the week of OPEX, which just ended on Friday, typically see a dip of somewhere between 2 and 3%, no greater than 4.5% to 5%, no greater than that. So again, when we come over here, and we look at our SPX, and we look at where we were for the last, let's call it 30 days, all right? We'll make it even easier. We'll just look at last week, 44, 65, 40. So quickly, we'll just do that, 45, 65, 40 times 0.98. So we'd be looking around 43.76 on a 2% drop, somewhere right down here. 44.31, right down here. So again, same thing applies. We'd be looking somewhere in that little range right there. Get that little dip right below the 10% line, and that would be the end of the dip, and all the algorithms would start coming in, going crazy and buying it, because really what it would wind up being is what I was showing here on the Thanksgiving chart. Is looking here like you've got your 1, 2, and this is your 3, somewhere up here placing around your 3, which fits, everything fits for where we are. Come down here, get a little bit of a 4, right into this 43.84, 43.37 area, and then go up here and get our 5, somewhere up here in that 45.50, possibly up at 45.60, if we were going to be extremely bullish, which I am not. And then from there, we'll get our little bit of a dip, and this would be wave 1 of wave 5. That's going to wind up going out to somewhere up there in this level. Somewhere up here around 4856, 4897, realistically around 5048 for now when we go out there. I am just very sensitive and respectful about the angle of the upward movement for the fifth wave when we go back and we want to compare it to other ones which we have for history. History tends to repeat itself. And I got to go back a little bit further. Hang on a second. Custom 1999. And I'll do the weekly. And here, even though this is the weekly, I kind of hope it fits. Here was March 20th. We had our hit our high, 13.75% correction, and then we gradually went back up towards that into August, failed, and then you had your correction that everybody knows about. Not so sensitive here in 2008 because it didn't take place, but you do have it here that you can see in 2018. 2018, you hit your peak there in January, had your 11% correction, 12% correction, bottomed on April 1, April 3, something like that. And then we gradually climbed back up. We took out that high right here of January. We took it out when we started at the end of August, and we wound up topping there in September. It took us an entire 6 months to get back that 11% that we dropped. So, like I say, I'm sensitive only because I've been there. I know what it's like. I know what everybody wants to expect, and I don't see an aggressive move up here above 4590, 4560, or 4600 during the course of these next couple of weeks. I don't. We've got earnings coming out. I think that we're going to spend a little bit more time chopping around in this zone, but definitely avoiding those low 4300s as we go into April. And then as we go into May, gradually moving up here into the mid 4600s. As we go into July to the lower 4700s, and you see the way that it progresses. So in any case, enjoy your weekend. Have a fantastic day. Thank you all very much for everything. I did spend time on the construction site today. The 8 houses are established. Now what we need to start doing is putting in the windows and finishing everything, which I'll get on site and wind up doing next week. But have a fantastic weekend, a great day, and I will see you guys in the chat tomorrow.